Welcome back. The National Treasury has decided not to adjust personal income tax brackets and rebates for inflation in the 2025-2026 financial year. This may result in higher tax liability should you receive a salary increase. To explain what this means for the fiscus and your pocket, we are now joined by strategic lead stakeholder engagement and legislation at the South African Institute for Taxation, Keitumetse Sesana. Keitumetse, very good morning to you. Thank you so much for making time for us this morning. Let's start off with the decision that was announced during the budget speech that there won't be any adjustments when it comes to the tax brackets. What's the implication of that? Also considering that right now you have some people that are saying that as it stands, they've already noted that this has had an impact on what they are able to take home.
Thank you very much for having me, Aldrin, and good morning to you and the viewers at home. It is exactly that. So the about turn to freeze the PIT brackets and not to adjust them for inflation essentially means that your purchasing power at the till is being eroded for yet another year. If you may just allow me just to take a step back, just to take the viewers into the trail as to what happens in the tax system. So we know that South African tax system is a progressive tax system, as many other jurisdictions around the world. That means the more you actually earn, is the more tax you should be paying. So the decision by the finance minister or the Ministry of Treasury not to adjust the tax tables means that even if you earn more, you're progressing in terms of actual earning. The tax brackets push you into higher and higher brackets, which means that your purchasing power is being eroded by additional taxes, although your income isn't actually increasing. Therefore, when you get your increase letter, it all looks, all hunky-dory and you're happy that you got the increase, but in actual effective tax rate terms, you are taking home less. You're actually in a worse off position because those brackets were not adjusted for inflation.
Yeah, so just explain that to us. By how much percentage points are we looking at, and what's the role of inflation in all of that?
So if you look at the budget review that was supposed to be tabled on the 19th of February, there the Minister of Finance had taken a decision to adjust the lower two brackets by full inflation and then partial adjustments to the rest of the brackets. The adjustments were about 4.85% in order to compensate for, the effects of inflation, right? However, because the VAT hike didn't go through and the Treasury had to look for more money, they froze it. So the tax tables did not increase for inflation at all. That means that even though your income has increased by 5% as per the data from your employer, because the tax brackets had only been adjusted by 4.85%, it wouldn't really have made much difference, but it would have cushioned the blows, which means that your income would have moved with the tax brackets, right? And you would have actually been in a better position. But now that it's frozen, it means that you are actually in a worse off position. If you can just allow me just to do a small calculation, not too high level, of what this actually means. If you look at the 2016 year of tax, right, and you do the calculation as per the brackets there, your effective tax rate that you would have paid would have been about 45,000 Rand, right? If you take the 2026 tax brackets, because now these haven't been adjusted, you would have paid an effective tax rate of about 65 or odd thousand Rand if you look at the brackets as they stand now. That is working on an assumption that you earn a gross salary of 200,000 Rand between those 2 years that hasn't really been adjusted. So the same salary, but because of the non-adjustments in tax brackets, you're paying a higher effective tax rate, which is the actual percentage of your total income that you hand over to SARS. So you're actually in a worse off position because those brackets were not adjusted. Some tax experts say that in order for you to compensate for the effects of this non-adjustment in inflation of the tax brackets, employers actually have to increase your salary by a percentage above inflation. So not the usual 5% or 5.5%. in order for you to just barely make it, you need an increase of about 6.13 to 6.5% in order for you to counter the effects of this non-adjustment in the PIT table. So that even if you are pushed into a higher bracket, your income is able to survive and you actually have some purchasing power.
Okay. Is that possible at all to start that conversation with your employer post agreeing and signing on the new salary increase, to say that, listen, now that the decision has been taken not to adjust these brackets, can we revisit the conversation about a salary increase? Or can I say that because my tax liability is set to increase, can we rather not increase my salary then?
So it would actually be, the latter would be a bit unfortunate, but we generally advise, taxpayers, myself, or even tax practitioners, to have the proactive conversation with your employer. To actually consult a tax expert if you don't understand how the calculations work would be the first step. SARS has a plethora of tax calculators, income tax calculators, that you can play around with some of the figures, that you can see what your actual take home is, and then have the discussion that a inflationary adjustment is not going to do much for you, given the effects of the finance minister announcing this non-adjustment to the PIT tables, and then perhaps play around with the figures that we've suggested now, the 6%, the 6.5%, just to show your employer that this is what you would like to take home, or what you should, the increase that you should be given in order for you to mitigate the effects. But a proactive discussion is what needs to happen. Don't just assume that when you get the letter of increase that it's all hunky-dory. In fact, it is not hunky-dory, because the effects of inflation and the non-adjustment to those tables are eroding your purchasing power at the tills, over and above the conversation that we've had about the value-added tax increase that we've discussed at length.
Okay, so my disposable income becomes less, but the fiscus would be smiling, because
Yes.
they essentially would be generating more income. Speak to us about the bracket creep and what that means and what it means for the state.
So for the state, that is going to accumulate about 19.5 billion rand that they expect to claw back as a result of this bracket creep. That obviously is going to go into the state coffers. Initially, at the original budget that was tabled in February, because of the partial and full adjustment for inflation to those PIT tables that they had proposed just to alleviate some pressure off taxpayers, the fiscus was aiming to collect about 3 billion rand. But we know, because of the about turn of the VAT and they had to find the money some other way, they then chose to go for the PIT tables once again. So of the 28 billion rand that the tax proposals for the 2025-2026 fiscal year will bring into the coffers, 19.5 of that is going to come from taxpayers, or by means of this phenomena called the fiscal drag or bracket creep. So National Treasury, or the Ministry of Finance, is smiling because they are actually going to collect the cash, but it's not a good thing for us as taxpayers. And if you look at the preliminary announcement of the results that the commissioner had on Tuesday earlier this week, PIT is actually one of the most resilient tax bases amongst the corporate income tax and the value-added tax, collecting about 733 billion, representing about 12.46 increase from the previous financial year, 23-24. It just goes to show that of the South Africans that are registered and are paying taxes, which is, of course, another conversation, because there's not enough of us paying taxes to carry the burden of the state, PIT is the go-to for many administrations, and unfortunately, it is the case for the South African Finance Ministry as well.
Yeah. Speaking about the provisional revenue results that were announced by SARS, when we were in conversation with the Commissioner about 2 days ago, he also mentioned that when it comes to personal income tax, they had overestimated salary increases to above 8% during the 2024-2025 financial year. So salary increases actually came in at, I think he said, just above 4%. I can't remember the correct figure, but he said it was just above 4%. So if that trend continues, would that then mean that the state won't actually be able to reach that goal of that 19.5 billion?
So if you look at the budget review, and thank you for that question. So the trends in employee compensation had declined, as the commissioner had said. If you look at the budget review, they've done a whole analysis on the trends of employee compensation. Yes, it had decreased in prior years, but for the upcoming fiscal year, if I may quote, they say there is an improved outlook for employee compensation, which alongside additional revenue and the non-adjustment to the PIT tables for inflation will bring in that money. So the estimations that I think they will now do the calculation on how they'll collect that 2 trillion, looking at the employee compensation, there will be, I think, an upward trend, and then they will base they've based their calculations there on, and I think they won't fall too far from that envisaged 19.5 billion collection.